Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Shoals Technologies Group.
If you find our talks useful, please consider subscribe, like, and comment underneath because today we are unpacking a really fascinating and frankly completely polarizing contradiction in the market.
Yeah, it really is a massive disconnect.
I mean, we are looking at a dynamic that basically forces you to question what matters more. Like, is it the underlying health of a business or the immediate, visceral reaction of the stock chart?
Right, because if you pull up the chart for Shoals Technologies Group right now, you are going to see a sharp, brutal plunge.
Oh, it looks terrible. It looks like a classic falling knife.
It does. But then when you look at the top-line revenue, this company is growing at an absolutely blistering pace.
Yeah, I'm talking about the kind of revenue growth that most management teams would throw a parade for.
Exactly. And the divergence between that operational reality and the market's expectation is, well, that's where the most compelling opportunities usually hide.
Right.
For anyone looking to strategically allocate capital, these moments of maximum volatility and high confusion, they are exactly where you need to look the closest.
So our mission today is to figure out what is actually happening under the hood.
Yeah, we have to determine if this recent post-earnings gap down represents a fundamental structural failure in their business model.
Or, on the flip side, if it's a calculated, washed-out entry point for wealth building over the next 6 to 12 months.
Precisely. Because to build wealth, you have to be able to look past the immediate panic, tune out the noise, and understand the actual financial mechanics at play.
Okay, so let's establish the baseline financial health from the fourth quarter of 2025. We have to look at what is objectively happening at the company before we can understand why the algorithmic traders threw a massive tantrum.
Right, let's start with the top-line numbers because they are undeniable.
Yeah, Q4 2025 revenue hit $148.3 million. That is a massive 38.6% year-over-year increase.
And putting a near 40% growth rate into perspective is crucial here. In the industrial technology and energy infrastructure sectors, achieving that kind of scale in this current macroeconomic environment is just staggering.
Yeah, you rarely see heavy industrial components flying off the shelves like, say, software subscriptions.
Exactly. And looking at the data, this was not just a localized bump, right, or a single massive contract skewing the numbers. It was driven by incredibly broad-based demand.
Okay, so where was that demand coming from?
Well, they saw higher domestic project volume across the board, meaningful contributions, expanding their international channels, and significant growth in their original equipment manufacturer segment.
Wow, okay. And the raw gross profit dollars went up too, right?
Yes, they did. They generated $46.9 million in gross profit.
Which is up from $40.2 million the prior year. So the business is bringing in more revenue, and they are generating more total gross profit dollars.
But here is the catch.
Right, here's the trapdoor that sent the market running for the exits.
Yeah. The JAP gross margins contracted significantly. They dropped from 37.6% down to 31.6%.
Ouch.
Yeah, that 600 basis point drop is the entire focal point of the bearish argument. I mean, in any earnings report, a contraction of that magnitude is a massive red flag for Wall Street.
And just to clarify for everyone, when we talk about GAAP gross margins, we are talking about the generally accepted accounting principles measurement of what it physically costs to produce the goods, right?
Exactly, before any administrative salaries or corporate overhead are even factored in.
Right.
So a 6% drop on nearly $150 million in revenue means, well, millions of dollars in potential profit simply vanish into the supply chain ether.
Man, let me see if I can put this into a real-world perspective for anyone listening, because margin compression can feel like a really abstract accounting term.
It definitely can.
It's kind of like, imagine you own the hottest restaurant in town. The line is out the door, every table is booked solid, and you are selling 40% more meals than you did last year.
Right. Your top-line revenue is skyrocketing. The cash register is running nonstop.
Exactly. But behind the scenes, back in the kitchen, the cost of prime beef has doubled. The price of fresh produce is up. Paying your kitchen staff and dishwashers has spiked so dramatically that your actual profit per plate is shrinking rapidly.
That is a perfect way to look at it.
You are making more money overall because of the sheer volume of hungry customers, but your margin, that profit on every single steak you serve, is getting squeezed incredibly hard.
Yeah, the restaurant analogy perfectly captures the mechanism of margin compression. The volume is masking the unit-level pain.
Right.
So if we look at the specific ingredients of that margin squeeze for Shoals Technologies Group, it really comes down to three primary macroeconomic factors. You've got tariffs, logistics, and labor costs.
Okay, so the physical cost of manufacturing components.
Yeah, dealing with shifting trade policies that tax imported materials, securing freight in a constrained global logistics network, and paying the skilled labor required to assemble these systems, it has simply gone up across the board.
But didn't the market completely ignore a massive silver lining during the sell-off?
They absolutely did. Despite this painful input cost inflation, the company demonstrated incredibly strong leverage on their fixed costs.
Okay, wait, I want to pause right there because if I am playing devil's advocate here, strong leverage on fixed costs sounds like corporate spin for we're losing money on the product, but hey, at least our office rent didn't go up.
That's a fair point.
Why should you, as an investor listening to this, care about fixed cost leverage if the margins are actively bleeding?
Because the underlying mechanism there is all about long-term scalability. You know, a business has variable costs, the materials, the shipping, the direct labor, which all fluctuate based on the macro environment.
Right.
But it also has structural fixed costs, the administrative backbone, the executive team, the facility leases. By showing leverage on those fixed costs, management essentially proved that they can push 40% more volume through their operational machine without having to bloat their corporate overhead.
Okay, I see. So the underlying administrative engine is actually highly optimized.
Exactly. If the global supply chain normalizes, or if they successfully raise prices to cover the variable costs, all of that operational efficiency immediately falls to the bottom line as pure profit.
Okay, so the core machine is lean, but the raw materials and labor to feed the machine are temporarily bleeding them.
Right.
And that financial reality perfectly explains the brutal price action we saw on February 25th. The earnings report hit, the earnings per share officially missed Wall Street's expectations, and the stock just gapped down hard.
It fell off a cliff.
But here is where the narrative shifts from a simple earnings miss to a profound psychological disconnect in the market. The margin squeeze explains the sellout, absolutely. But it does not explain why the major Wall Street institutions are refusing to abandon ship.
No, it doesn't. Following that fourth quarter margin miss, the analyst community reacted swiftly, and on the surface, it looked devastating. They slashed their price targets dramatically.
Yeah, we saw price targets that were as high as $15 get aggressively cut down to the $8 to $11 range.
Right, and the new average consensus price target settled right around $9.75.
But wait, here is the crucial sentiment data that makes you stop and reevaluate everything. Despite slashing those price targets almost in half, despite the stock chart looking terrifying, not a single analyst downgraded the stocks to a sell.
Not one! Barclays, Jefferies, and UBS, all of these major institutional players, they maintained their overweight, buy, or outperform ratings.
Actually, I have to stop you there and just push back on this entirely.
Okay, go ahead.
If an analyst team completely misses the mark, watches the stock crater, and then cuts their price target by 40%, keeping a buy rating just sounds like Wall Street trying to save face.
Right, it looks defensive.
It feels like they are just trying not to look foolish for recommending it to their clients in the first place. Why should anyone listening to this trust a buy rating on a falling knife?
I mean, questioning the motives of institutional analysts is the right instinct. Face saving definitely does happen on Wall Street. But looking deeper at the mechanics of how capital flows in these specific situations, what you are seeing here is a textbook technical event.
A technical event? Like what?
It's known as washing out weak hands.
Ah, okay.
When a stock gaps down heavily on bad news, the market undergoes a violent sorting process. The retail investors who bought at the top, the short-term swing traders looking for a quick flip, and the high-frequency algorithms that only trade momentum, they get completely flushed out.
They just panic sell at the absolute bottom.
Exactly. But the institutional money, the funds that hold millions of shares based on 5 to 10-year time horizons, they operate on a totally different set of rules.
They aren't panic selling because their thesis hasn't changed.
Exactly. The divergence between the price action, which is driven by that panic short-term selling, and the analyst sentiment, well, that often signals a major contrarian opportunity.
So what are the institutions essentially saying here?
They are saying, the near-term margin news is undoubtedly bad, and we have to lower our immediate valuation targets to reflect the reality of those tariffs and labor costs.
Right.
But the core business model, the intellectual property, is still a buy at this newly discounted price.
Okay, so the negative margin news is now fully priced into the stock.
Yeah.
Everyone who wanted to panic has already panicked, which establishes a much firmer valuation floor.
Precisely. They are willing to look right past the current quarter's margin crunch.
Because they are focusing on something much bigger,
Right.
right? Something structural that protects the business.
Yes.
And that brings us to the underlying moat and a massive emerging macro catalyst that could completely rewrite the future for Shoals Technologies Group.
Right. To understand why a company can command near 40% top-line growth in a tough environment, you have to look at their intellectual property.
Which is pretty formidable.
It really is. In September 2025, they secured a new critical patent for their BLA architecture.
BLA stands for Big Lead Assembly, right?
Yes, and it is the absolute foundation of their economic moat in the utility-scale solar market.
Now, when most people think of a solar farm, you just picture thousands of glass panels sitting out in a field. But the panels don't just magically beam electricity to the grid.
No, the panels are just the visible surface. The real complexity of a utility-scale solar project is the electrical balance of systems.
Okay, so what does that actually mean in the field?
It is the miles of heavy copper wiring, the complex junction boxes, the fuses, and all the infrastructure that safely collects the direct current from tens of thousands of panels and routes it to the grid.
Sounds incredibly complicated.
It is. Traditionally, wiring a massive solar farm required an army of highly skilled, highly paid electricians out in the field, literally manually stripping wires, crimping connections, and building the nervous system of the power plant by hand in the dirt.
Wow. And the Big Lead Assembly changes all of that.
It radically reduces the installation time and the labor costs by moving that complex electrical work into a controlled factory environment.
I think the best way to visualize the mechanism behind this Big Lead Assembly architecture is to think about furnishing a massive building.
Oh, I like that analogy. Let's hear it.
Imagine you are tasked with furnishing a brand new 500-room hotel. You could buy traditional flat-pack furniture to save on shipping, right? It comes in thousands of cardboard boxes.
Right, the IKEA method.
Exactly.
Yeah.
But then you have to hire an absolute army of workers to sit in every single room, spending tens of thousands of hours deciphering complicated instructions, sorting out loose screws, and building every single bed frame and dresser by hand.
The labor costs alone would be astronomical.
Yeah, the delays and the inevitable human errors, it would eat your entire project budget alive. Now imagine if all of that furniture arrived at the hotel already completely pre-assembled from the factory.
You just take it off the truck, wheel it into the room, and plug it in.
That is exactly what Shoals is doing for solar farms. They are shipping the electrical nervous system pre-assembled. They are saving construction teams massive headaches and millions of dollars in on-site labor.
Building on that analogy, the time savings translate directly into incredibly deep relationships with EPCs.
And EPCs are the engineering, procurement, and construction firms, right?
Exactly, the firms that actually bid on and build these massive solar farms. Once an EPC trains its workforce to simply plug in the Shoals pre-assembled architecture, and more importantly, once they build their project timelines and competitive bids around those massive labor savings, it becomes incredibly difficult for them to ever switch to a competitor.
Because going back to manual wiring would completely ruin their margins and delay their projects.
Precisely. This dynamic creates exceptionally high switching costs, which is, well, the text-big definition of a durable economic moat.
That moat explains why the top-line revenue is so resilient. The EPCs need this product. But a strong moat only protects the castle, right? It doesn't expand the kingdom.
That's a great way to put it.
And that is where this speculative blue sky catalyst comes in. And this is the part of the research from UBS that I find absolutely fascinating because it bridges the gap between traditional energy and the biggest technological shift of our lifetime.
Yes, we are talking about the Battery Energy Storage Solutions segment, or BES.
This is the intersection where the solar infrastructure industry collides directly with the current boom in artificial intelligence.
Which, if you just read the headlines, seem like two completely unrelated universes.
Right. You have heavy industrial wiring on one side and large language models writing code on the other. It's crazy.
On the surface, the connection isn't obvious at all. But fundamentally, the future of AI is entirely dependent on the physical energy grid.
Right.
The surge in artificial intelligence, specifically the massive data centers required to train and run these complex models, it's drawing an unprecedented, almost incomprehensible amount of electricity.
We are not talking about the power draw of a traditional office building here.
No, we are talking about single data center campuses pulling gigawatts of power. The traditional aging power grid simply cannot handle this concentrated, massive new demand without failing.
Because you can't just plug a hyperscale AI data center into the municipal grid. The power draw would literally black out surrounding neighborhoods.
Exactly. So these tech giants need dedicated, massive power sources built right next to the data centers. And while solar farms are the fastest way to deploy new utility-scale power, there's an obvious flaw.
The sun goes down, but AI data centers have to run 24/7.
Exactly. The intermittency of solar is the primary bottleneck. That is why battery energy storage solutions, massive utility-scale battery banks are becoming the critical infrastructure for the AI revolution.
You need these massive batteries to store the gigawatts of solar energy generated during the day and feed a smooth, uninterrupted supply of power to the data centers at night.
Right. And UBS highlighted that Shoals Technologies Group has a significant multi-year upside in this specific segment. Their core expertise in the electrical balance of systems, handling the massive thermal and electrical loads of solar farms, it translates perfectly to wiring and connecting these massive battery storage facilities.
So this is the blue sky upside. It is a massive potential growth driver that simply is not modeled into that current $9.75 average valuation. The analysts are valuing the stock based purely on the current margins of wiring solar panels, completely ignoring the potential windfall of becoming the go-to electrical architecture for the batteries that will power the AI data center boom.
The market is currently entirely focused on the near-term margin pain, ignoring the long-term infrastructure play. However, as an investor, a blue sky future does not erase the immediate storm clouds overhead.
Yeah, we have to stay grounded here.
If you are going to deploy capital and build wealth safely, you cannot afford to be blinded by the AI catalyst. You have to look objectively at the immediate, tangible risks threatening this setup over the next 3 to 6 months.
Right. We cannot just ignore the bearish side of the thesis. And the biggest threats right now are those policy and tariff risks, along with the looming fear of structural margin compression.
Let's dissect the tariff risk first. Tariffs and trade policies fundamentally alter supply chain economics, and the solar industry relies heavily on imported components.
Right.
Regardless of the political landscape in Washington, the objective reality is that shifting renewable energy subsidies or implementing new anti-dumping tariffs on materials imported from overseas directly and immediately impacts the gross profit of a company like Shoals.
Because if the cost of importing specialized components or raw materials spikes by, say, 20% due to a new trade policy, it eats directly into the bottom line. Which brings up what I think is the most critical question for anyone listening to consider right now. We are living in a reality of sticky inflation. Are these tariffs, these increased logistics expenses, and these higher factory wages a permanent new reality for Shoals Technologies Group?
That is the big question.
Are we looking at structural margin compression, where their profitability stays depressed at 31% forever? Or is this just a temporary cyclical pothole that management can steer around by adjusting their pricing strategy?
That is the multi-million-dollar question the market is actively trying to price in right now. The bearish argument for structural inflation asserts that skilled labor simply costs more permanently, and global supply chains have fundamentally deglobalized, making them permanently more expensive to navigate.
So if that proves true, that lower gross margin might just be the new normal.
Right. Conversely, the bullish argument for cyclical inflation assumes that these supply chain shocks eventually smooth out over time. But more importantly, it relies on the pricing power created by the economic moat. A company with the dominant big lead assembly patent should, theoretically, be able to pass these increased supply chain costs onto their customers.
Because, going back to our earlier point, the EPC construction firms are not going to go back to building solar farms the slow, expensive manual way just to save a few bucks on the wire itself.
Exactly. The labor savings of the pre-assembled products still outweigh the price increases. The switching costs are just too high, which gives management the leverage to raise prices and protect their margins.
But Wall Street needs mathematical proof, not just theory, right?
Absolutely. And that makes the catalyst calendar for the next 3 months incredibly important for the stock's trajectory. The Q1 2026 earnings report is going to be the ultimate proving ground.
Institutional investors are going to be scrutinizing that release with a magnifying glass.
Oh, without a doubt. They need to see if management can stabilize those gross margins above that 31.6% floor.
They need to prove on paper that they are actually passing those inflated costs along to the end consumer.
Exactly the data point the market is waiting for. And looking slightly beyond the immediate quarter, we also have to monitor the broader macroeconomic trend regarding interest rates.
Because utility-scale solar projects and massive battery storage facilities are highly capital-intensive endeavors. They require borrowing hundreds of millions of dollars to build.
Right. If we see potential interest rate cuts materialize as we move through 2026, it drastically lowers the cost of capital for the entire industry.
And cheaper capital means the math works better for the developers, which means more mega projects get greenlit, which directly translates to more demand for the big lead assembly architecture.
A lower cost of capital directly accelerates the conversion of their massive project backlog into actual recognized revenue.
Wow, okay. We have covered a massive amount of ground today.
We really have.
We looked at the top-line boom, the painful margin squeeze, the psychological washout of the institutional gap down, the highly protected IP moat, and the massive AI battery infrastructure catalyst. It is time to synthesize all of this into actionable insight. What is the final investment thesis?
After heavily weighing the elite fundamental top-line growth against the very real near-term supply chain risks, this setup earns a bullish score of 7 out of 10.
Okay, 7 out of 10.
The strategic target horizon here is a hold for the next 6 to 12 months. This is absolutely not a quick momentum flip. The specific calculated play is to wait for the Q1 2026 earnings report to confirm that margin stabilization.
And if they hit it.
If management proves they have established a definitive floor and margins begin to show a rebound, the stock is heavily primed to re-rate higher, moving aggressively toward those $11 to $12 consensus institutional targets.
So here is the elevator pitch for you as you review your portfolio strategy. You have an opportunity to look at a company delivering elite, near 40% revenue growth in a really tough environment.
Yep.
Their intellectual property moat is deeply entrenched, meaning their market share is highly secure against competitors. And the recent post-earnings sell-off did the painful, dirty work of washing out the speculative excess and weak hands.
Which offers a highly compelling, significantly discounted entry point for patient capital. They are executing flawlessly on the top line while navigating what appears to be temporary, solvable margin headwinds.
It requires patience and a willingness to absorb near-term volatility, but the risk-to-reward ratio at these heavily discounted valuation levels heavily favors the long-term holder, provided that the upcoming Q1 data confirms the margin floor is secure.
Exactly.
As we wrap up today's analysis, I want to leave you with one final lingering thought to explore on your own. Consider the sheer, almost unimaginable scale of energy that is going to be required to power the future of technology over the next decade.
It's massive.
If the rumors and institutional whispers are true, and massive tech data centers increasingly rely on battery energy storage solutions to keep their AI models running off the fragile local grid.
Does a simple solar component company suddenly become a critical backdoor infrastructure play for the entire artificial intelligence revolution?
It is a fascinating question to ponder as you look at the energy landscape. Thank you for joining us today. If you found this analysis valuable for your wealth building strategy, please make sure to subscribe, leave a like, and drop a comment down below with your thoughts on the energy grid of the future. We will see you next time.